Good morning. Today is Wednesday, October 19th, 2022. Earnings coming in. We haven't got to the really exciting ones yet, but we did have one big blockbuster last night. As a pun, as Tom will talk a little bit about that later.
Go ahead, sorry.
We're going to start off with an oil announcement that's coming later today at about 1 p.m. from President Biden. The administration will release the last 15 million of the 180 million barrels that they authorized in March that have been being released over the last 6 months. I think this is about the third time they've made this announcement that they're going to release something that's already been said that they're going to release. But the news is that the administration is also considering more sales from the SPR this winter. Bear in mind, we've drawn down from about 650 million barrels to about 400. And they do want to call on oil companies to lower their costs to consumers, which makes it tough because I feel like it's a market price and it's not determined by the oil companies. And the final piece of this plan is that they will also unveil a restocking plan. Now, they won't make purchases for months, but they do plan to buy back oil when prices are at or below $67 to $72 a barrel, which begs the question, what if oil does not go below $67 to $72 a barrel? That's like saying, I want to buy the S&P 500. Currently, it's 3,500-ish. I want to buy it when it's 1,000. Yeah, great. I mean, but, is it ever going to get there?
Yeah, on top of that, too, you've got a group of countries that are oil producing that hate us, that know what price we want to buy it at and may or may not have control over supply and demand, or at least supply, and they can finagle that so that price doesn't get there. And maybe they can even cut production so it goes up, so we actually have to buy it higher.
I mean, to put this in context, I mean, Tom, imagine if you were the biggest buyer of municipal bonds in Georgia, and our clients wanted municipal bonds in their portfolio. You had to buy municipal bonds at some point. And you said, I'm going to buy municipal bonds when they get to a 6% yield. Do you think they'd ever get to 6% yield? No, they'd use the backstop.
Well, give it a couple of days in the Fed. Yeah, we might get there pretty soon.
I think.
Yeah, I get your point. It's one of those things where, he's living in La La Land if we think that we're going back there anytime soon.
If we go back there, then it's because we're in a recession.
Yeah, it's because we're in not just a recession, but a deep recession.
Now, I will give the administration credit. The SPR releases have worked to bring down prices. Crude oil prices are down about 20% since we started this program to release oil from the Strategic Petroleum Reserve. However, it was meant as a bridge to bridge the gap to when U.S. oil began to produce more. Instead, U.S. production is actually starting to fall. And this is exactly the time where government forecasters in March said that it was supposed to really start to ramp up and accelerate. On top of that, you have OPEC's production cuts. And on top of that, you still have China that's been locked down, and they're going after growth next year. So if we have Russia and OPEC continue to cut, China going back to growth, oil prices are going to go higher. And that's when you really need the Strategic Petroleum Reserve. But if we continue to draw it down, there's not going to be any reserves to be drawn upon. And I think that's the big issue the administration's fighting right now. But they also have to balance that with the political reality of the moment, and that is that the Republicans are gaining on the polls as we head into the last week or so, a couple of weeks before the midterms. And there are some concerns among Democrats that they peaked too early. So that oil announcement's coming later today, again, about 1 o'clock. I wouldn't be surprised to see oil actually go up on that announcement. I don't know if you have any different thoughts, Tom.
No, I think it definitely will go up. It's so obviously stupid and ill-advised that, everyone can play it. It's telegraphed the whole way, right? So, I don't know. It's ridiculous. It's spending your rainy day fund or your emergency fund in case things really hit the fan to go to Disney World is not a good idea. And that's what we've done here. So, we'll see how it goes. I don't expect positivity out of that.
And the problem is they're playing with a weaker hand right now. It's not an easy hand to play at this point, but maybe we should have done something different a little bit 6 months ago. Earnings really hitting the tape now. Netflix was the big one last night. It's up well over 10% pre-market. Disney shares are up about 2% in sympathy with that. The big news here is that subscriber memberships actually grew for the first time in 3 quarters, that they benefited from Stranger Things. The content slate for Q4 is less clear, but at any rate, Netflix is not going to be providing guidance on subscribers going forward. So this is the last quarter that they're going to do that. They want investors to focus more on free cash flow, on revenue, and on earnings. They will be releasing an advertising supported pricing tier in November, and the company is very optimistic about that piece of the business. Ultimately, I think the worst may be over for Netflix, but at best, you're talking about a value company. I think that the growth period is also over. And I think that you're having a nice relief rally today, but I don't know if we're out of the woods yet, Tom.
Yeah, I'd agree. I think that they're making the shift from a growth company to a mature company. I mean, there's gone are the days where they're just going to be accelerating in double digits. I mean, it's ingrained in society. Everybody knows about Netflix. It's not like suddenly they're going to unlock a new market where they're going to get hundreds of millions of subscribers that didn't already know about Netflix. I think the subscriber growth, no longer reporting that is smart. Everyone focused on that for years and years and years. And even when Disney rolled out Disney Plus, that became the focus on Disney, regardless of what the fundamentals of the business were. So dropping that, we'll see if others do as well, in order to sort of say, hey, here are our financials, value our company based on that, and not by how many new subscribers we added. Because we've learned over the last couple of years that it can ebb and flow by a major amount, and maybe not necessarily fundamentally change the outlook on the company from a financial standpoint, but people get hung up on that one number, and the market will correct massively on the stock price.
And it changes the story to an extent, because you're looking at a company's moat. We spend a lot of time looking at a company's moat. Distinct from the valuation, we want to know how ingrained this company is in the fabric of society. Procter & Gamble, for example, that we're going to be talking about a little bit later, is a company that has a very strong moat. It's just going to be difficult for anyone to replicate that business. Netflix, you can define its moat by its subscriber base. So you start to see that subscriber base decline, and that's where it really hurts the story piece of the Netflix stock. So valuation is one piece, moat's another piece. Subscribers obviously don't impact valuation in the near term, but they do impact one's sense of the company.
Correct. Yeah.
From one, value company to another, J.B. Hunt, trading at about 16 times earnings. This is a really excellently run business. We think that it has great long-term prospects to own through the cycle. However, and the stock's actually up 2% on these earnings results, which were good. The problem is they kept talking about this, what they call a pivot, not a correction, but a pivot in the trucking demand market. They say that the peak season, which is starting right now, is pretty much a non-event, which is alarming. And they just kind of threw that out casually on the conference call. And I had to look at the transcript. I had to replay it to make sure I got the quote right, because that's remarkable that peak season is looking like a non-event. And what you have is retailers have been already burned once by having too much inventory. They don't want to get any more inventory. And so they're not really accumulating all that much there. I would say for JB Hunt, 70% of their business is rail, and rail velocity is improving. So even if overall demand slows down a bit, their rail business should be able to capture some of that slack because it's just coming off an extremely low base. So that's what's keeping JB Hunt in it. But for a lot of these trucking companies, especially the brokerage plays, it is very, very tough out there. And I don't think it's getting easier anytime soon. It's people are going to lose a lot of jobs. A lot of small 2, 3, 4 truck businesses are going to go away. You just can't make it 6 months with operating on the margins that they operate on when spot rates are going down so much.
Do you think that's a net positive for JB Hunt in the sense that they can potentially consolidate or capitalize on some of those free drivers?
And they are saying that. They are saying that driver availability has improved. The cost of those drivers is rising, but the cost of everything is rising. So, but they do say that driver availability and ability to recruit and retain drivers has significantly improved from where it was even 3 months ago.
Yeah, so I guess it's tough for the industry at large, but probably better for the bigger players than
Yeah.
in terms of consolidation.
The market needed a correction.
Yeah.
Just like a few markets. Abbott and Procter and Gamble reported this morning, and this is what I don't get. So Abbott, for example, we'll start there. They provide a lot of COVID testing. They provide medical devices. They also provide Pediasure, Ensure, and pharmaceuticals, generic branded pharmaceuticals outside of the United States. They also are the maker of Similac, which is a baby formula that is not in production. Their COVID testing revenue actually saved them this quarter. They posted another $1.7 billion of COVID testing revenue. The estimate was just $500 million. Elsewhere in their business, it was just a mixed picture. Their Freestyle Libre diabetes product wasn't performing as well as I thought it might, especially internationally. And so that's something that we'll have to continue to watch going forward. But this is a company that was riding a wave, got a little bit sidetracked by all the COVID hype, focused probably a little bit too much on that, and now is trying to reorient itself in this new reality. I don't know if you have any thoughts on that, Tom?
Yeah, I was actually kind of surprised at how strong it actually was. I mean, I haven't taken a COVID test and I mean, it's been a while. And it's just not as everywhere all the time as it used to be. So it's surprising me that they beat so bigly on the estimate there. But I mean, everything else kind of fell in line. It's a company we've been curtailing our exposure to quite a bit over the last probably 6 months or so. So I'd say they outperformed, but not in a way that I would want them to. And I probably wouldn't be continuing to hold that stock in large quantities.
Tesla and IBM report tonight. Tesla will be watched extremely closely to see how the actual demand is trending there. We know that for the last number of years, Tesla sales have been a function of supply. Can they actually produce these vehicles? Now it's transitioning to demand. So I'm going to be focused on that with Tesla tonight. But then finishing off the earnings roundup with Procter & Gamble, the number of, you have a couple good earnings reports. You're a week out of an inflation report. You don't have any Fed decisions for another 2 weeks. And all of a sudden, people actually look at the fundamentals. The problem is you look at the fundamentals, and a lot of these companies are continue to benefit from price increases. If I go and I look at the organic price change for Procter & Gamble over the last 5 quarters, you went from 1%, 3%, 5%, 8%, and this most recent quarter is 9%. And that's not on food. It's not on energy. This is on healthcare products, the fabric and home care business. So your Tide Pods up 11%, baby and feminine and family care, your diapers are up 8%. I mean, you're seeing your Gillette razor, part of their grooming business, up 8%. That's the biggest price increase that I've ever seen from Gillette. I mean, they couldn't get anything going there for the longest time.
As if razors aren't already ridiculously expensive for what they are.
So when people talk about inflation peaking, I actually see inflation accelerating on the core side.
Yeah,
that's what concerns me.
Every single one of those numbers is higher than the core inflation print that we got, last week. So the question is, when do they stop those price increases? At what point do they deem it appropriate? I think it's more likely that that's when we see the peak of inflation, when we go back to a 1%, on some of these things on a quarter-over-quarter basis.
And that's going to be tough to get to because the CEO, John Moeller, was on CNBC earlier this morning. The conference call is going on right now. But he was talking about very little trade down so far. He says that, they look at private label, and private label may be gaining 20 basis points of market share, 0.2%, which is de minimis. People are not really trading down in any big quantity right now. And Procter & Gamble right now is being able to pass through more than all of its cost increases and being able to reiterate its earnings per share guidance and get its growth, but solely because of pricing. In fact, volume was actually down 3%. 2 points of that was because of Russia, Ukraine. But still, you're talking about flat volume for the companies getting organic growth in the mid-single digits because of pricing. So,
why would they not continue to do that until they hit a wall where they start to see trade downs?
That's going to be the MO. We've even seen it with Starbucks. They're looking to just focus more on innovation, which is code for pricing, and Disney raising prices. Netflix is going to raise prices and use the ad-supported tier to. It's remarkable to me. But I think there's more to come in terms of inflation, and there's more to come in terms of UK inflation. CPI inflation in the UK was up to 10.1%, hit double digits. The last print was 9.9. It was a little bit higher than expectations. The CPI core, there was only 6.5%. The CPI core inflation in the UK is actually lower by 0.1% than it is in the United States. So, you know, it's really bad in the UK. It's just as bad here in the United States. We don't have the same energy inflation and the food inflation that they're having there. But it's a bad story. And I don't know if the Fed's going to stop in the mid fours like the market thinks. I don't know what your thoughts are, Tom.
I mean, I continue to just absolutely hammer the fact that I think the risk is to the upside on hikes. You know, I've said it from the beginning. I think we'll get 9. I think that's the number for the year. We already got 3, so we got 6 more built in. If you look at futures, that continues to be right at the 5.7 range. I mean, that's up significantly. That's a full hike from just a couple of weeks ago. So, I mean, it's possible we could even get more. I mean, we're looking at a slight chance of a full point raise at the next meeting, which would be, I think, quite a shock to the market. I think it would really cause a lot of gyrations. The question is that enough to slow demand? If people really get worried about how many times the Fed is going to hike, will they actually start to slow demand? And if so, is that going to cause a material change in CPI? It's really tough to say how quickly these things come in, but right now there's 11% chance we get a full point, which is not zero. I mean, it's pretty close to zero, but it's not zero. And so it's definitely on the table, you know, which would be the most aggressive move they made yet so far.
Yeah. And I mean, I think that people are hoping for this miraculous shift that all of a sudden we'll be going three hikes, and then the calendar flips to 2023 and it's Fed's going to pivot. Fed's not going to raise anymore. And I don't know why people think that is the case.
Yeah. I mean, if you look now, it looks like we're going to get roughly 2 more hikes between January and May based on futures. So we'll get 6 in this calendar year and then additional, you know, call it 1 to 2 between then and May. When earlier this year, I mean, futures were showing a potential cut in February, and now we're looking at an additional 2 raises after February.
And it could be 6.
And it could be a lot more. I mean, who knows?
So, I mean, I think you put that all together, and this is why, you know, right now, I think you still probably have a week and a half as we look through into the big tech earnings next week. I think that you might have some similar reactions to what we saw from Netflix, but I think that we have to keep this in context and understand where we are in the cycle. And this does not mean we're raging bulls right now. But we have to manage dynamically, and that's what we're trying to do. So with that, if you have any questions, just let us know. Put it in the chat, send us an email. We can address it here. We can address it one-on-one. But we're happy to help, want to keep those lines of communication open. And for now, that's it. But we'll see you tomorrow at 8:30.
Good fellas.